Welcome friends once again to the NPTEL module on international trade theories and empirics. We are here on the 9th week to identify the connection to the earlier modules, and accordingly we designed or titled the lecture as types of foreign exchange market. The previous lecture is on functioning or the concepts of foreign exchange market. So, here I will take you through the different types of foreign exchange market. We have already clarified the concepts of foreign exchange, but still I will once again emphasize, though we have already explained this in the previous lecture, that foreign exchange is highly connected to the theories of the exchange rate determination, their dynamics, then the concept of law of one price, commodity arbitrage, absolute purchasing power parity and relative purchasing power parity. Okay. Then some aspect like exchange rate overshoot. We in the long run, its long run value in short run. Then there are connection of this with fixed exchange rate and flexible exchange rate. Then how monetary policy and fiscal policies are effective, we will emphasize in due course of our lectures. Okay. So, I am going to discuss this equation of the PPP and the relative PPP and absolute purchasing power parity in detail. Okay. So, coming to the basic introduction of foreign exchange market, that where the individuals or firms and banks buy and sell foreign currencies or foreign exchange. So, in simple term, buying or selling of foreign currencies is part of the foreign exchange market. Now, assume there are two economies, one is called United States and another is called India. Now, United domestic currency is rupees and the United States currency, as we all know, it is dollar. Now, we need to define the exchange rate of India in terms of dollar. So, or dollar in terms of, usually the exchange rate is interpreted as per unit of dollar and how many rupees we can exchange. So, like in India it is 71 rupees, for example, rupees against $1, that is called our exchange rate, that is also called our nominal exchange rate. Okay. So, basically one foreign currency can purchase or replace how many domestic currency is the part of the definition of foreign exchange. Okay. Now, so the exchange rate is defined as how many rupees divided by dollar. If R equal to 1, then rupee is equal to purchase with $1, that is 1 can be exchanged with 1, both the currencies are equivalent to each other. Now, under flexible exchange rate system, R is determined by the intersection of market demand and supply curves for dollar or we can say rupees. Okay. So, if you are taking the demand and supply of rupees, then that will be exchange rate related to rupees. Now, if you are now sticking to dollar, then now accordingly demand and supply of dollar is to be defined. When we say depreciation of a currency, there are broadly two types of undervalue. One is called depreciation and another is called devaluation. Depreciation we refer to the fact where the rate of exchange or the value of a currency declines eventually due to the market mechanism. Okay. The market mechanism helps in increasing or decreasing or change its value of its currency against another currency, that is called depreciation. But when a country takes a stand in controlling its exchange rate through certain direction, though it is under the purview, some of the extent it is under the purview of the IMF and as well as WTO, majorly IMF, where the financial aspects are dealt. So, when any country takes a change in its exchange rate forcefully without the market to take some correction for the country, that approach is called devaluation. Okay. So, for reducing the value through some arbitrary technique is called devaluation. So, if the dollar price of the euro increases from 1 to 1.5, dollar prices of the euro, that means for euro how many dollar can be replaces. If the dollar price increases from $1 to $1.5, the dollar, so that means the dollar value depreciated, okay, and in reverse the euro value increased. All right. Now, coming to the reverse side called appreciation, appreciation of the currency refers to a decline in domestic price of the foreign currency. Okay. If the dollar price of the euro decreases from 1 to let us say $0.5, then the dollar has appreciated. Now, here is a diagram which explains the exchange rate between euro and dollar. We are referring to Dominic Salvatore book and their diagram also, and you can also follow simultaneously for a parallel reading. Okay, and I am quoting that books, and this type of diagram you can get it from almost all the books on international trade, and basically a simple demand curve and supply curve, demand for euro and supply of euro. So, demand for euro and supply of euro and how it is connected to the exchange rate of euro as against dollar. Now, at point demand and supply of euro get settled at E that defines 1. So, dollar and euro are defined to be equivalent at point E, with 200 is the per day, 200 million euro is demanded and supplied per day. Okay. This is as per the flexible exchange rate system. I think you might be confused once again. There are two broadly, one is called fixed, another is called flexible. Then within fixed we can also refer some argument for pegged exchange rate, where the government takes some deliberate step to peg it with other currencies, then that is different. Here flexible exchange rate, fixed exchange rate and flexible exchange rate. So, fixed exchange rate where the rate between one country to another country while exchanging their resources to be flown from one place to another place with a particular contract called exchange rate, and that is fixed. When the rate is fixed all totally over a period of time as per the contract, that is simply called a fixed exchange rate regime. Now, flexible exchange rate is different than that of the fixed, and it is based on the market rate. We have already clarified in the previous lecture. Now, we are clarifying different concepts related to exchange, different types of exchange rate. One aspect is called cross exchange rate. Cross exchange rate is called the exchange rate between each of the pair of currencies with respect to the dollar is established. The exchange rate between the two currencies themselves or cross exchange rate can be calculated. Once again, let me mention that once the exchange rate between each of the pair of currencies with respect to the dollar is established, the exchange rate between the two currencies themselves or cross exchange rate can be calculated. So, cross exchange basically once a particular currency you have calculated, then other currencies you can also calculate based on this cross exchange. Okay. For example, here we have dollar and euro, which we already cited, that the exchange rate is 1.25 between dollar and euro, or per euro that can purchase 1.25 US dollar, and the exchange rate is 1. What is this basically and the exchange rate 1.25 exchange rate is $2. Now, why is it so? Basically the it is how it is divided. It is basically divided 2 divided by 1.25. Okay. Now, why is it important and how to clarify it? Let me simplify it. First of all, when you know that the exchange rate for one currency with another currency is defined as 1.25, okay, US dollar. So, euro and dollar we have already linked. Now, when we have also seen that pound sterling, that is British currency, pound sterling is exchanged with dollar at 2. That means per pound sterling can purchase $2. Okay. So, but per euro it is of 1.25 US dollar. Okay. So, the cross exchange rate is the basically that is dollar divided by euro. This is basically what we wanted to find out the how much euro we can purchase with 1 unit of pound sterling. So, we are interested in finding we were interested in finding euro. We are interested in finding euro divided by pound sterling, 1 pound. Now, we already know that the exchange rate of pound sterling is of this divided by this divided by whole divided by dollar upon euro. Now, euro we want in terms of in the numerator we want euro. So, dollar cancelled. So, it will be equal to this divided by pound, is not it? So, this is what we want. So, then we simply divided this 2 divided by 1.25, that is basically 1.6. So, now how many euro a pound can purchase? It is 1.6. Okay. Coming to the another type of exchange rate is called effective exchange rate. Effective exchange rate is basically a weighted average method, weighted average of the exchange rates between the domestic currency and the nation's most important trading partners. So, it is weighted average of nations most important trading partners and their currencies. Okay. So, domestic currency with their partner currency, instead of just dollar we used to refer or only euro, like our currency, India's currency is of how many euro we can purchase, how many rupees you can purchase with $1. Okay. Now, it is not just dollar, what are the standard currencies and how many rupees against to their standard currency. So, there are two concepts emerged in the context of effective exchange rate. One is called near and another is called rear. Near is called nominal effective exchange rate and this is rear is called real effective exchange rate. Nominal effective exchange rate is actually the weighted average of bilateral nominal exchange rate of the home currency in terms of foreign currencies. Whenever we simply take the bilateral the foreign currency and the home currency, the simple dollar rupees divided dollar is called nominal exchange rate. Okay. Effective because we have taken the weighted average of some of the currencies. But now, in case of real we have to adjust with inflation. Okay. So, is a weighted basically the real effective exchange rate is a weighted average of nominal exchange rate which is adjusted to relative price differential between the domestic and foreign countries. It relates to the purchasing power parity hypothesis. So, when real is referred, we actually find the connection with the adjusted inflation, okay, adjusted prices. So, basically we are referring to the purchasing power parity hypothesis. Okay. So, that can be referred and the exchange rate can be referred internationally when it is in PPP terms. The data provides the indices of rear and near of Indian rupees of 6 to 36 currency bilateral weights monthly average, which I am going to show it here. Here is the data I was just trying to explain. that in terms of trends in nominal and real effective exchange rate of rupee. Okay. And here for the data with a base year is given to calculate. Base year is as 93, 94 is considered to be 100, but the nominal effective exchange rate is with 6 currency index is given. The nominal effective with 36 currency is also given. So, in both the cases we will certainly take a weighted average of the 6 currency or 36 currency, but in case of real we have to adjust with their price. Okay. So, there are methods involved in adjusting. Now, based on this 94, 95, look at this, when we adjust with the price, real effective exchange rate is higher. Okay. So, that means for rupee it is against the rupee, more rupees can replace with $1 relating to real. Okay. So, again against 36 currency is also given. Now, as per the latest data of Government of India, I think till this also there are differences, and as per but the base period has been changed to 2004-5 prices, because since we are adjusting with prices, so inflating aspect has been neutralized in PPP terms. So, both the prices has to be taken as a ratio. Okay. So, this table we have already clarified related to nominal and effective rate of exchange rate of rupees since 1994-95. Other details you can follow it from the RBI site. Okay. RBI. All right. Now, the index for exchange rate is since a country interacts with many countries, it wants to see the movement of domestic currency relative to other currencies in a single number rather than looking at bilateral rates. Now, that is it would want an index for exchange rate against other currencies, just as it uses price index like CPI and WPI do, we also calculate the index for other countries. This show how the prices of goods in one country change with the change in prices by another country. Now, coming to further clarification related to near and rear, the Reserve Bank of India tabulates all those details like rupees nominal effective exchange rate in called near in relation to countries of 36 trading partner countries, and this is, as we already mentioned, it is a weighted index, okay, where the country with which India trades more are given a greater weight in the index, where the weight trade volume is higher. A decrease in the index denotes depreciation in rupees, whereas increase reflects appreciation. So, that means when the index value increases, we say it's appreciation. Okay. So, coming to this now there is one more measure that is even better referred in the international context for comparison is called real effective exchange rate, and this is essentially an improvement over the near, because it also takes into consideration of the variation in inflation in various economies. The rear is weighted average of near, okay, adjusted by ratio of prices to foreign prices, domestic prices to foreign prices. Now, the exchange rate are now presented here as per the latest information from RBI. Now, rear is much higher than that of near, and it has already reached 116.51 as against 31 we just see near about our exchange rate only. Now, as the chart shows here, we have simply shown it in the diagram that near terms the rupee has depreciated to its level lowest level since November 2018. Since 2018, okay, November 2018 rupees has depreciated. Okay. Now, all right. Now, again coming to the rupee has been steadily losing value showing the Indian economy is reducing competitiveness since especially July 2019. July 2019, I think it is here. It's for the reducing. Now, in real terms, also rupee has depreciated in March and fallen to its lowest level since September 2019. So, September 2019 reached at the lowest level. Okay. Then coming to the difference between trends of near and rear was due to India's domestic retail inflation and being lower relative to other 36 countries. Okay, as domestic inflation started rising, the rear too also started depreciating like the near. Now, these are the latest figure from the RBI related to near and rear. You can refer to this link. You can simply click, it will direct to the chart. This chart which I am referring taken today itself, and the base year has been changed to 2004-5 and considered to be 100 from where it is compared. Okay. Now, from 100 it is higher or lower, that is important. Now, as per 36 currency index is given in RBI side, and 6 currency index is also given there. Now, near and rear the latest data could be compared. All right. Now, this is first one is near and second one is rear. All right. And first one is trade based weight, second one is export based, wherever export value is higher, that based on that weight there are differences. Okay, 6 currency rate, 6 currency trade weight is also measured here. You can just have a comparison. After discussing the very basic concept of foreign exchange rates, we need to identify some other concepts of foreign exchange rates like arbitrage. Arbitrage is simply called the purchase of currency in one market for immediate resale in another market. Okay. The buying from one place and selling another place, the person who is dealing these two incident is called arbitrager. Okay. So, arbitrage keeps the exchange rate between any two currencies the same across different markets when the market is freely defined or very competitive. The purchase or reselling closes differences in exchange rates by reducing currency available in the low price market and increasing availability in the high price market. Simply this is a demand and supply framework. So, wherever the price is higher, it is expected to have lower more availability of the foreign exchange. Now, I think you might have seen in banks the foreign exchange rates are quoted, and here the demand and supply is given. When the demand in the international market increases for the foreign exchange, I think when the demand for that increases, that particular currency can replace more of another currency. So, the exchange rate actually increases. Okay. So, since there is a shift of this, exchange rate actually increases from here to point E prime. All right. Coming to spot and forward rates, we will discuss the exchange rate determination later in our next class in detail. There are some other conceptual differences called spot rate, forward rate, options, futures. We will also explain in today's lecture. A spot rate basically the rate that calls for payment and receipt of the foreign exchange within 2 business days from the date when the transaction was made. So, it requires 2 business days. If the rate is contracted for 2 business days and that has been traded, it is simply called spot rate. Forward rate, which can be forwarded to a later date, and the date is very binding. The exchange rate that calls for delivery of the foreign exchange that has been purchased. Today, for example, I purchased dollar, and with spot rate contract, then it has to be sold within 2 days. If I purchase through forward rate, usually that is different than that of the spot rate. that calls for delivery of the foreign exchange either in 1 date contract, 3 months, 6 6 or 12, 6, 12 or 24 months after the date the contract is signed. Okay. So, when the date contract is signed, usually the after that date it is being fulfilled for selling. Okay. So, there are other types called forward discount and forward premium. Forward discount, because since we sell it at a higher rate, a higher date is a later date. So, the whatever the return we get, like percentage per year by which the forward rate is below the spot rate, the rate at which we have purchased, if the forward rate is less than that, okay, less than that, then that is called forward discount. The date at which it is to be executed, if that is less, there are some discounted value of that original purchase. Where it increases, that is called a premium. Okay. Then how to find out the rate? In a year it is 4 times traded, because on the average if it is 4, then 4 is multiplied to calculate the forward discount or premium. So, forward rate minus spot rate divided spot rate is defined as the forward discount or forward premium. Okay. This minus this divided by this is called D or P in case of forward market. Now, another concept, another type is called currency swap. It is basically a spot sale of a currency combined with a forward repurchase of the same currency. Okay. So, a spot sale of a currency combined with a forward repurchase of the same currency, like it is attached with a combined approach, spot sale with a contract of further purchase, repurchase of the same currency. Okay. That is as part of a single transaction. So, not just sale, also a contract is attached with buying. So, most interbank trading involve the purchase or sale of currencies for future delivery are done through currency swap. So, currency swap basically it is sale and repurchase, okay, on a contract on a spot rate with a later date for repurchase. So, the concept of futures comes to our understanding. It refers to a 1972 laws or period. It is usually called forward currency contracts for standardized currency. Futures is actually referred to the market where standardized currencies are traded in a future date. Okay. So, all the exchanges are not accepting in this particular segment, and select, especially in this case, select dates on an organized market. On an organized market is important. So, the traded currencies in the future market is Japanese currency, British currency or British pound sterling, then Australian currency, Swiss currency, Canadian dollar, Mexican that is peso currency, Australian dollar is also euro, etc. Okay. You can check in the document Google search also, those details will be there for you. So, what is the difference between forward market we have discussed as against future market? Future market has a specified date, but forward market has a specified duration. Okay. Now, other details are like in future market we have fewer currencies. Okay, very specific currencies are dealt in future market, and that too standardized contracts only. The contracts are completely standardized, in all any other type of contracts are not accepted. Few specific delivery dates, as we already mentioned, that is 3rd Wednesday in March, June, September, and every quarter the 3rd December is defined to be the delivery date of future markets. Like subjects to daily limits are also set. There are few geographical locations also, like Chicago future market, New York future market, London, Frankfurt and Singapore. Okay. Then it is usually of smaller amount as against another one. Usually this is very helpful for small firms. These can be sold any time before the maturity, that is one of the important aspect. but the maturity is given on the specific date. Okay. So, we have already differentiated. Coming to foreign exchange options, okay, futures we defined, we are now defining options. Options are contracts giving the purchase or the right, but not the obligations. It is the right to buy, as called buy is also called call option, or to sell is called put option, a standard amount of a traded currency on a stated date. Okay. That is European option date. The date is called European option, or any time before the stated date. If any time before the stated date is there, in that option type is called American option. Okay. They give the option for before the time that can be sold, and if that is at a stated price, a particular price is quoted, that is called strike or exercise price. Okay. So, there are 4 or 5 concepts simultaneously discussed. One is called strike rate. I think you might have heard in the stock market, future market in the shares or the stock market, there are strike rates, there are American options. American options basically give the dates before the date of purchase and resale. European option is very binding to the particular date. Okay. So, sale option is called in the stock market called put option, buy is called call option. Okay. If you are trading in stock market for options, if you simply say call option, that means you are buying. Okay. And this gives the right contracts or right contracts to the purchaser, not the obligations. Okay. So, neither forward contracts nor futures are called options, because options have all those important features. Okay. They are not similar to options. Now, whenever a future payment must be made or received in foreign currency, a foreign exchange risk is involved, because spot rates are vary over time. Whenever spot rates are dealt, it is usually valid for a particular date or particular time, but over the time when futures or options are dealt, it is attached with risk. So, when risks are parting with the trading units, it always calls for protection. What is the protection we are going to discuss is called hedging. Okay. So, hedging is necessary. How we can hedge or reduce our protection, what kind of instruments are being traded in the stock market to reduce the risk. So, basically the contracted future currency payments may become more expensive if the domestic currency falls in value. Okay. For example, a contract requires 1 lakh euro payment in 3 months time. Okay. If the exchange rate is currently traded at 1:1, 1 euro traded with $1, the expected dollar cost is 1 lakh dollar as against the euro. If the exchange rate changes, like exchange rate now becomes 1.1, now the value of dollar depreciates as against the euro. Now, the 1 lakh nowhere remains same. So, in the intervening months, the dollar cost rises to 1 lakh and 10,000. So, now 1 lakh 10,000 is equivalent to 1 lakh after that contract time or at the end of the contract time. So, a risk is attached in the future market. So, contracted future currency receipt may fall in value if the domestic currency increases, and accordingly we have already cited, and you can please have a look. Therefore, what is suggested is hedging to reduce or avoid the foreign exchange risk. So, in case of options, what kind of dealings are there? Buy at current spot rate and deposit the receipt in an interest earning account until the funds are needed. Okay. So, that is one option where hedging risk can be reduced. So, once you buy at a spot rate and deposit for interest earning receipts, that can reduce our risk. In case of buy a forward contract which is attached with a month or year. So, typically this entails paying a forward premium, increasing the cost of the transaction. So, so that also related to the hedging. Buying a call option, if not exercised, the premium is lost. So, the premium, so that is also important in the context of call option. Similarly, there are besides this type of risk, there are speculations, that is simply opposite of hedging. This is the acceptance of foreign exchange risk in the hope of making a profit. When we part with the risk of the foreign exchange fluctuations, that means it is a part of bearing the speculation. If the speculator expects the spot rate in 3 months, that is time to be with $1 with €1, she may sell euros at a current 3 months forward rate at 1.10 per euro, okay, with the expectation that she will be able to buy euros to cover her sale at the lower spot rate. Okay. So, at a higher rate, we generally have with a higher rate with 1.10, if buying at a lower rate with that expectation, then that speculation can give better return. Okay. Coming to some aspect of stabilizing the speculation, the purchase of foreign currency when the domestic price falls, okay, when the domestic falls, better to purchase, or is low in the expectation that it will soon rise, leading to a profit, or selling of foreign exchange when the domestic price rises. So, that will actually stabilize the speculation. Stabilizing speculation actually moderates fluctuation in the exchange rate over time and serving a useful function. Now, other approaches are like destabilizing speculation magnifies fluctuations in exchange rate over time. This is related to destabilization, just the opposite what we have said. I think you can just go through and find out. There are some concept called interest arbitrage. Arbitrage, we have generally said the middle intervention, the interference. Here interest rate is also acting as an arbitrage. This is the transfer of short term liquid funds abroad to earn a higher rate of return. Okay. So, wherever the interest rate are different, we can also transfer and get the interest rate on it and for getting profit. So, uncovered interest rate arbitrage is one of the concept when the transfer of funds abroad entails foreign exchange risk due to the possible depreciation of the foreign currency during the investment period. Similarly, covered arbitrage is the spot purchase of the foreign currency to make the investment and the offsetting simultaneously forward sale of the foreign currency to cover and remove the foreign exchange risk. Last couple of clarifications are there, like efficiency of foreign exchange market is also defined through markets defined to be efficient if prices reflect all possible information. When all the information are there, then that is called efficiency in the foreign exchange market. The foreign exchange market is efficient if forward rates accurately predicts the future spot rate. Okay. So, if the empirical evidence is mixed, then that might be problematic. So, the last two sides we also clarify in due course of our time, okay, in other lectures. Last it's though I have said here as efficiency of foreign exchange market, but that is not clearly understood unless we do not understand the macroeconomic dynamics. Okay. So, we will clarify all those rest of the aspect and please follow all the concept or different types of foreign exchange market. With this, I think I should close here. Thank you.